Oh, I don't think they were talking to me. Okay, so chapter 19 is about the pensions and other post-employment benefit plans. Okay, so in this chapter, we will do an overview. This is the chapter, the topic. The accounting part is not um, difficult, the accounting part, but there's lots of other works to be done before the accounting starts. And the pension and other post-employment benefit plan can be very complex, and it's not something at most of us would have lots of direct experience. So the challenge is kind of understand the plans we're trying to report. Once we get that done, the where is that make microphone in his? I don't even know where to start. Okay, seems to be fine. So we do a quick overview and we talk about the two types of pension plans. The accounting for pension plans and the other post-employment benefits are the same. So we just focus our discussion on pension accounting. And the two types of plans, defined contribution and defined benefit. Um, the accounting for defined contribution is straightforward, whereas for defined benefit, there's a lot more information we need to deal with. And so we'll focus on the accounting for defined benefit plan. And then last, we will introduce a worksheet that allow us um, to incorporate all the information needed, all the accounts that's involved, and all the journal entries that's involved in one worksheet. And we show the worksheet with a comprehensive illustration. So that's the plan for today. Oh, well, actually for this week, because we needed 2 days for this part. First, the overview. Okay, so if most of us, when we get a job, we get paid. So that's our compensation. That's a transaction. We provide service, we got compensation. But lots of times, especially like for permanent jobs, that in addition to the wages salary you receive now, you also receive other benefits such as pension. Uh, the way it works is um, you actually earn this benefit as a result of working now. But unlike wages salaries, you don't receive the benefit until after you retire, right? So that's kind of how it goes. Um, because we're talking about the benefit of, like, probably if you offer plans to your employee, to many large numbers of employee, and if we were talking about the benefit throughout the retirement, so we're talking about the large amounts. And the pension plan, the accounting for pension plan has gone through significant changes. I think the first, somewhere in 80s, I think it was the early 80s, uh, the pension obligation is required to be recognized. Before that, it's not recognized, right? Because there's nothing paid. Like the employer could say, well, you have pension when you retire. But when that first happened, the employer is not required to record it, because this is a promise that you don't have to deliver until decades later. And then because it's not recognized, there's no money put aside for that either. So I don't know, you guys are too young to remember this, but this is how I learned my English. I watched, TV. And at that time, Golden Girl, I don't know, Golden Girls, it was old. But one of the stories is that the Rose husband worked all his life and he's supposed to have a pension. Even her husband died, she's supposed to have that benefit. But her husband's company employer went bankrupt. So she had to end up having no pension benefit because there was not money set aside, right? So then in early 80s, that they recognized this problem, like employee really there's no security if there's no money set aside for this benefit. So the company are required to recognize the pension as liability. And when General Motor, GM, first implement this new accounting standard, like the old pension benefit that they have been promising in the employee for decades, all of a sudden should be recognized. The liability is so big, its shareholders' equity become negative. Think what happens if you credit a liability. What do you have to debit? Expense. And the expense will go into your net income and reduce your return earnings, right? So the joke was who owns General Electric? Did I say General Motors? Retired folks, right? Because on the balance sheet, they're claiming to trump everything. Okay, so that's why this is very important because the amount, and it can be complicated. The plan itself, how the benefit is determined, can be complicated. Okay. Many organizations are taking advantage of data analytics tools to help predict and impact members' options and lifestyle risks. So there's a small profession that's involved heavily in the pension, things like that, called the actuaries. So they are basically statisticians. They predict such a thing as inflation, as the mortality rate, life expectancy, job retention, things like that. And all these are required to estimate your obligations. Now, with the advance of large big data analytics, so this will be like a very kind of interesting area because whatever they uncover through their analysis could be the feedback to the company and the employee how they should make adjustments and so on and so forth. Now, this is a chart I use to illustrate how pension plans work. So we have two parties, primary parties. We have employer, also called the sponsor. And we have employees. They are employees today. They will be the retirees in the future, and they will receive the benefit. So right now, at this point, employee provides service to employer. And in return, they earn wages salaries. But on top of that, they will also earn pensions and other post-retirement, post-employment benefits. But that benefit will be received in the future. So these two arrows, it's a time. It can be very long. Okay. So when employees retired, they will begin to receive benefits. Now, as I said, we don't want what happened to Rose's husband to happen to too many people. So the companies now and the employees are required to put money aside. So the benefit will be covered. Okay, so there is such a thing called the pension fund. Okay, and there are many different versions of pension funds, and the employer can contribute to it. Employer definitely have to contribute because, right, that's the pension benefit part. Employee can contribute as well. lots of times actually like the employers contribution is conditioned on employee also contribute. Okay. Um, and so this fund is restricted. So this fund like doesn't matter who owns it, like we can talk about later on, but this fund is earmarked as a pension fund. It will be invested, this is money be invested, but no one should touch it, not even employee, right? We know one of the pension fund will be RSP. We heard of that in Canada, right? We always encourage maxed out your contribution. That if you have a RSP, that's yours, but you cannot access it without a huge penalty. Okay, so this fund is protected in that way. And when the future comes, your benefit would come out of this pension fund. Okay, and then this pension fund, as I said, it's restricted, so it's often there's other party involved in managing this funds. Not depend on the two types of pension funds. There is slightly difference, like who controls that, who manages that. Okay, so that's the idea, right? That's like you work now, and as a result of the service employees provide today, the benefit will be received in the future. Okay, in order to pay for this benefit, there is a pension funds created, and employer would contribute to that pension fund, and the fund will be managed, will be invested. Okay, and employees may contribute, that's called a contributory. If employee doesn't contribute, they're just non-contributory plans. So, and in the end, the benefit would come out of this pension fund. So that's how it works. Okay, so that's just the detail to explain that. Okay, there are two types of pension plans. One is defined contribution. The other one is defined benefit. So I will continue to use this chart, but okay. So there's two different setup of the plan. One is called the defined contribution. So there's always a formula. Companies use a formula to determine the pension benefit, right? So defined contribution, the formula would say how much the employer should contribute. Okay, so see there's a blue dollar sign. So that is what defined in the plan formula. Okay, that's what's defined in plan formula. So for instance, an employer said, you have your salaries, but each year you worked, the employer would contribute 8% on top of the salary. Usually that's 8% of your total salary as a pension benefit. Okay, so that's on top of your salaries. And quite often they require you match up. Like an employer would contribute 8%, for instance, if you contribute 6% of your salaries to the pension plan. And so both your 6% in my example and your employer's 8% would goes to the pension fund. Who owns the pension fund? You do. However, you cannot spend the money. Like you definitely cannot spend money. So this will be registered as pension funds. You can even tell the fund company how to invest, but you do not have access until you reach your retirement age. Okay, so this is easier for the employer, right? It's not cheap, but easy, because all we need to know is based on the formula how much I need to contribute. Okay, as long as I made a contribution, I'm done. So the contribution would be your pension expense, And as soon as you made the contribution, the employer's obligation is fulfilled. There's a risk. When we talk about future, there's a risk. And the risk is at how the pension fund is managed, right? And the better it's managed, the bigger the funds, the better off the employee will be in the future. However, if it's managed poorly, there will be less benefit for the employee. And on top of that, when the employee retired, they have to plan it because that's the total resources, total funds available for the benefit. If you live too long, could be a problem, right? So you need to spread it out, right? So there are all kind of risk, but it's all on the employee, the future retirees aside. So as you really have to manage it well. Okay, so that's defined contribution plan. Okay, it's easy for employer, but it's not necessarily cheap, right? Because usually the contribution is not less. Okay, but there's less uncertainty. The alternative plan is called a defined benefit. Okay, so as you work today for employee year, when you retire, you will receive benefit. So the formula of the pension plan defines how much benefit you will receive. So a typical formula would be for each year you work, you will receive 2% of your, usually it's terminal year salary, the last 3 years of your employment, something like that, when you retire. So say if you work for 30 years, let's assume like the year before you retire or average last 3 years, something like that, your salary is $100,000. So that means in your retirement, you will receive 60% of your last year or last 2-3 years salary. You can specify that. So it'll be 60,000 a year, each year until you die, as long as you live, right? So that's kind of, so the benefit is defined. Okay. How much the company should contribute, that is not defined. And in fact, this contribution would depend on the benefit for sure, estimated benefit, but it also depends on how well this fund is managed, right? If the fund has very high return, the company would not have to contribute too much. But if the fund is managed poorly, like eventually it's employer's responsibility to ensure the benefits are paid. Okay. And because we said the risk employee have, so the companies are required to fund this plan to some level, because everything changes, right? The value of a portfolio fluctuates. So it's not require you to be 100% funded all the time. But I think there's I'm not exactly sure. I think it may change from jurisdiction to jurisdiction as well. I would say something like 80%. That looks like most of the funds are funded to that level, around that level, right? So what would happen is there are situations this fund is managed very poorly, so the company would be forced to put a large amount of money to the fund to ensure the benefit is paid. But if the funds perform really well, the company can actually take money out, because this is the company's funds. This is company's assets, really, right? Companies made a contribution to that, and the company relies on this fund to meet obligation, to the retirees. However, unlike regular asset, this is out of reach of the company. You cannot use the money in this funds to pay your bills or for any other reasons, unless like, when it's overfunded to significantly, you can take money out of fund. In fact, these are managed by what do we call the trustees. So the group people have the expertise, knowledge, and integrity to manage this funds. They decide how it will be going to be invested, and they pay the benefits, and if they like, you can't take the money out without them consent, so 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 this plan, there's less risk for the employee. You just live as long as you can, right? And you will, as long as you live, you will get a benefit, and you know how much the benefit is. That's defined, right? That's what defined benefit means. Now, the uncertainty will be on the employer side, right? It depends on how long the employee lives, the inflation, and so on and so forth, but also depends on how this fund is managed, So these are two different type of plans. Well, okay, I forgot. Remember, I always have a theme to review each chapter. And I do have a theme for this chapter as well, but I decided to leave it to the end of the chapter because with the discussion of this chapter, I think it will go better. So I didn't forget that. I do have it, but it's at the end. Okay, so these are two different of plans, and I have all the information in here. So I won't go through that anymore. Yeah, okay, so there are some lots of new terms in this chapter, right? So here are two things. So one is the planned assets. So it's called the planned assets, also the pension funds. So these are in a way the assets, the money put aside and invested, okay, with the purpose of paying the benefit out of this assets in the future. So that's called the planned assets, and it's also the fund, pension funds. And then there is this a benefit obligation, sort of like a liability, right? Just as a concept called the benefit obligation. Doesn't matter if it's a defined benefit, a defined contribution. With the defined contribution, however, this one is met as soon as the contribution is made. So this liability is satisfied. So for the company's concern, you don't have to worry about it anymore. But if it's defined benefit, this DBO, defined benefit obligation, is a liability of a sort, right? Because that's the obligation you have promised to fulfill in the future. So there are two things. One is planned assets, one is defined benefit obligation. They are related, they're linked. Okay. And then from company's perspective, you need to estimate, measure the planned assets and the defined benefit obligation. Okay. And because the funding is depends on the relative magnitude of these two, right? So like if the planned assets is more than the benefit obligation, the plan is overfunded. There's more money there than what you need to pay in the future. But if the defined benefit obligation is more than planned assets, then it's underfunded. You don't have enough yet to meet obligation. So you need to contribute, right? So the contribution will depend on the relative magnitudes of this two. Okay, so then keep tracking these two are important. What factors affect the plan assets measurement? What factors affect defined benefit obligation? On top of that, we have to recognize pension expense, right? It is an expense because by definition, that's earned, like that you earn it by the service provided now. And expense is all the costs incurred to earn revenue, right? So in order to get you service this current period, the company have agreed to pay you wages, salaries on top, have agreed this pension expense. So that is current expense, despite the benefit will be in the future. So the company has to record expense. And if the company makes contribution and these two things are not the same, don't have to be. If the company makes contribution, you have to record a contribution. So these are the things. But this is not unlike any other expense in the way it's you recognize the expense, that's a accrue measure transaction, and then you recognize your payment. That's a cash measure transaction. They do not have to happen same time, right? They do not have to same. From that perspective, that's straightforward. However, how to determine expense? What's the actual measurement? That is really difficult, complicated, not really difficult, complicated. Okay. So let's see. So that's like I'm summarizing all these. Defined contribution plan is easy. Employer contributions defined, right? So employees' benefit are not. Once the required contributions are made, no further obligation on the part of the employer. So that's the one. Amount paid are attributed to individuals. As we said, those pensions, each person would have a account with a designated a bank or investment firms. You have a open up a pension account, and then the money goes to your account. It's your account, even though you cannot access it until you retire, but it's your account. Okay, so the amount paid are attributed to individuals. Everybody has account. Contribution are a fixed sum or based on the salaries. It's defined in a way. It's defined. Contribution is defined. Now, employee assumes economic risks. Okay, so the benefit would depend on the amount that have been contributed. That's only part of it. Income that has accumulated. That's the investment returns, right? That's the investment returns. Investment alternative available for retirement, yes. Like you decide how to invest, okay? You decide how to invest with the permission, with the options that are given to you by the banks that manage your account or by the investment firm manage your account. You can decide you want it all equity or fixed income, international, domestic, you know, all that. I have to do that. And yeah. So continue with the defined contribution. Employer's obligation is dictated by amounts to be contributed. Okay. So usually if you contributed fully, there will be nothing on the balance sheet, right? You know, just like a debited wages expense and credited wages payable. And if you paid it, there will be nothing. However, if there's a lag or there's a lead in the contribution, so you may just have an account that's very similar to a payable or prepaid. Just like your rent, if you paid, there's a lag, you have a rent payable. If there's lead, you have a prepaid rent. So that's to the extent of balance sheet presentation. Okay. Annual current service cost, that's the obligation to plan in exchange for employee service provided in the current period. So, we don't have to worry about contribution about that. There is a couple of, well, let's just say one more thing. That is the past service cost. We'll see this again later. So what is past service cost? It's usually resulted from change of the plan terms, a new revision of the plan benefit terms, such as, they may decide to retroactively grant you this benefit to the years of service you have provided in the past. Okay, so one of the example would be like if you are on probationary service basis at the first, so you work for 2 years on probational basis. Usually you don't have benefit for probationary position, but then you become a permanent employee. Sometimes you can retroactively to receive the benefit that you are not entitled to when you are on probation. Okay, and that will be past service cost. Sometimes there could be just change the benefit plan for a group of people, things like that. But this past service cost usually it's retroactive adjustment. Usually you should recognize right away. Recognize right away. Okay, these are accrued, and that would be just the prepaid or unearned. So that's quite simple, straightforward. No, not a big deal. Our focus would be on defined benefit plan. Okay, so the plan specifies either the benefit to be received by employee or the method of determining the benefits. Okay, so in any case, the plan focuses on the benefits, not on the contribution. So this is complex. So in order to determine the benefit, we need a lot of assumptions, a lot of estimates. Usually we involve service of actuary. Okay, the most complex plan provides benefits that vest based on employees' length of service. Okay, so yeah, we'll talk about the vesting later on. Okay, accounting for these plans requires expense and the liability to be recognized over the accounting period the services are provided, right? The services provided now, expense should be recognized now. And as you recognize the expense, that create obligation to the future, that's liability. The employer's obligation and the cost to be accrued as an expense as the employee provides service. Okay. So to ensure benefits available at a retirement, there's usually a requirement that funds to be set aside during service life. That's the requirement to create plan assets, requirement to plan assets, right? So the risk is on the employer side because how much you need to contribute depends on how the size of the assets and how well it's performed. The assets and liability belong to employer because the employer is ultimately responsible for that. Okay, so that. Sometimes the employer can recapture excess trust assets. Okay, so what's the trust assets? That's assets managed by trust. And if the asset exceeds in size of the obligation, overfunded, you can recapture that excess sometimes, which is that. Okay, so that's about that. So now let's go over the detail part. Accounting for defined benefit pension plans. Okay. So there's a two very important concepts. One is the employer's obligation to pay out benefits in the future for employee service to the date of statement of financial position date. So this is the liability, defined benefit obligation, right? It's accumulated the benefit the employer has agreed to provide to the employee. Think for a moment, how would this be measured? How would this be measured? It would be the discounted of the benefit, right? So that if you think about it, you can envision a annuities of sort. At the starting date of the annuity is the date of your retirement, because there's no payment before that. And the magnitude of net annuity, it determines how long you're going to work, because it's on terminal salary. What are the expected promotion and raises, okay, inflation rate, and so that would determine the on top of the defined benefit formula, okay, the magnitude of the benefit. So the annuity, the payment size. Now, how many payments? That depends on life expectancy. And then in order to discount it, you need a discount rate. And first you need to discount all the annuity to the date of the retirement. And then you need to discount again from date of retirement to the statement of financial position date. So the back chapter, there is a one person defined benefit pension plan. So they give you assumption this person is hired such a date, and he's expected to work for such a period, and his expected salary at retirement is such a level, and then when he retired, we expected to live so many years, and then give you a discount rate, and you can calculate one person's defined benefit pension plan obligation. And then you go on next year. So, if you work 1 year, you get 2%, if you make 2 years, you get 4%. You have to remeasure the liability now based on 1 year closer to retirement, but you have 2 years, 4% as your benefit, and then recalculate. So there's an example to show that. In theory, it's like we know how to do that. It's in theory, the accounting we use is not much different from bond, right? And the interest payment principle when discounted. But this, the measurement of the benefit, the terms involved to calculate that liability involves great uncertainty, right? And it changes, the assumptions can change as well. Okay, so that's defined benefit obligation. And then the corresponding part, counterpart is the plan assets. It's the money set aside to fund the obligation. And this one changes as well, right? So each time you make a contribution that increases, each time you pay, if you are not retired yet, but there are people retired. From a company's perspective, that covers everybody. People who are still working, people who are already retired, right? It covers everybody, so that their plan assets are covered, would be covered, benefited to everybody. The people who are receiving benefit now and people who have not started to receive benefit yet. And their defined benefit obligation again covers everybody, so there will be benefit paid. Okay, so each time benefit is paid, the plan asset will decrease. And then the plan will be managed, invested, and it will earn a return that will also affect plan asset size. So these two are constantly monitored. We need to measure those two in order to determine the rest. Okay. So as I said, it's very complex to estimate the obligation, and there are different assumptions made and different focuses, right? Different focuses. So right now, so there are three ways to measure benefit. One is a vested benefit. So these are the benefit, like we know what a vest means, right? Vest means once it's vested, then it's secured. Like you can't lose it anymore, right? So lots of times when just like when you start a job, sometimes they come with a probation period. Same with these kind of benefit. If you leave too soon, you won't receive benefit. When it's vested, that means doesn't matter you continue to work or not. The benefit you earned up to that point, vesting period, will be yours regardless. Okay, so vested benefit would only be the benefit obligation that's you already actually earned. Okay, and translates to the calculation of benefit is based on current salary levels only. Okay, so say if you don't have any raises anymore, this will be minimum your benefit. Okay, so this is the smallest benefit. Accumulated benefit, that's calculated on all years of service, both vested and non-vested, and use current year salaries. Okay, and the projected benefit is use both vested and non-vested service, but based on future salaries. Like this is the one we actually use right now. When I talk about defined benefit obligation, that usually is based on this projected benefit. That's among the three. This is the largest estimate, right? Usually the future salary factoring in inflation, promotion, pay raises will be larger than the current salaries. Okay. So this is just the details about, remember the funding requirement? So under ASPE, this defined benefit obligation to determine the funding and for financial reporting are not exactly the same. So that's just the that's the peculiarity of ASPE. It's not the same as in under IFRS. Okay, so to measure defined benefit obligation, defined definite benefit obligation is a permanent account. The balance gets carried over from one year to the other, right? So for each period, the changes in defined benefit obligation are determined by these factors. So current service costs will increase the defined benefit obligation. It's just additional benefit earned by employees for current period services provided. That's called the current service cost. Right? That's for any ongoing pension plan, you have that. Interest cost. Now, by now, we should be like familiar with this. When you have a liability, that time value of money counts, the liability would have interest accrue onto it, right? Because liability will be measured at the discounted present value. And when time changes from this year to next year, the interest will be accrued down. So this interest cost will based on the balance you carry. Okay, this is the same as bonds we counted for, notes we counted for, interest cost. And when the benefit paid, payments made to employees will reduce the obligation. Just like when you have a debt, if you make a payment, debt goes down, right? So that's that. Now, these two here may happen sometimes, but the ones, the three on the top, they are recurring items, right? Most plan will have those, right? Recurring items. One is past service cost. One is actuarial gains or losses. Okay, so the next slide explain that. Past service costs benefit added retroactively as plan are amended. When you make changes of the plan, additional benefit may be added. Like as I said, maybe they will retroactively give you benefit for your provisional period service. They may expand their plan to include the members that were not entitled to the benefit before, right? So these are based on the amendment. So that's called the past service cost. When you add these benefits, your obligation goes up. Actuarial gains and the losses, this could then go other way. Remember the assumptions that are required, like the life expectancy, the inflation rate, discount rate, and so on and so forth. So when that assumptions get revised, there may be an additional obligation, there will be a loss, actual loss, or there will be less obligation, there will be a gain, right? Remember we talked about the revenue, the assets liability approach, right? When the measurement of assets and liability changes, we have to adjust that on our balance sheet. And as a result of that, there will be revenues or expense gains and losses. So there's the same. Well, we measure the benefit obligation based on a bunch of assumptions. And when the assumptions changes, our obligation could change. And as a result of that, it will have gain and loss. So when liability increase, we have loss. When liability decreases, we have a gain. So that's about the defined benefit obligation. Could be 5 things. Okay, could be 5 things. So the beginning balance, adjust for that changes, give you the ending balance. So that's that. And then we have plan assets. Okay, the money set aside. So they're restricted, as I said. So what are they? What are the assets? They can be cash. They can be investments in debt or equity securities. Usually these are not accounting regulations. Usually they have laws just to mitigate the risk the pension funds are exposed to, because this is not, you're talking about these people's financial security in retirement, right? So usually they restrict the risk level you should expose these funds to. So usually they're minimum. For years, you're not even allowed to invest in equity. Okay, now you can invest in equity, but low risk. Also, real estate investment properties, that's low risk. Okay, so these are what actually in the fund. So again, the plan assets, that's also permanent account. The balance gets carried forward, right? So for each accounting period, These changes will change the balance of the plan assets. Contributions from employer, and if it's a contributory pension, employee should contribute as well. Okay, so the any money put in, additional money put in would increase your plan assets. Return on investment of plan assets would be added to the plan asset as well. And the payments to retirees will be subtracted, will reduce the plan assets. Okay. So we talk about that. Funding requirements are set by federal to provincial laws. So as there is a funding requirement, you must put a certain amount of money aside. You must put a certain money aside. And then the its amount contributed is tax deductible. Okay. The amount contributed may not be the same as the actual expense. Okay. And as I said, in most cases, the funding requirement is not 100%. It's not, you should have exact amount. There is a little bit of margin, like within that, that's fine. Now, here is the thing that's kind of unique to pension. We have an asset, we have a liability, but neither is on the balance sheet. Neither plan assets nor defined benefit obligation is on the balance sheet. Instead, what's on the balance sheet is the difference. What's on the balance sheet is difference. And the difference between the defined benefit obligation and the plan asset is called either surplus or deficit, depending on which one is bigger. Okay, depend on which one is bigger. Okay. If the plan asset is greater than the defined benefit obligation, you have a surplus. So that will be an asset. If the defined benefit obligation is greater than plan asset, you have a deficit. It will be a liability on the balance sheet. Okay, so only the net amount is reported on the balance sheet. Okay, I'm not sure what I just said. Okay. The plan assets and defined benefit obligation will be reported in the footnote. And so in the worksheet, we call these memo accounts. Memo accounts. So they are only disclosed in the footnote. They're not in the financial statements proper. Instead, the ledger account associated with these two memo accounts will be the net defined benefit assets or liability, depending on which one is bigger. Okay, so that's how it's reported. Net defined benefit assets or liability. The surplus or deficit, that's the ledger account, whereas the other two are not on the financial statement. So that's that. Now, what about the pension expense we need to recognize? What about the pension expense we need to recognize? So in theory, this pension expense is cost of defined benefit plan. Okay, so it's all the factors that affect defined benefit obligation and the plan assets except the payments, right? The payments canceled out. Okay, because if you think about the assets and liability approach, when liability increase, you have expense. When assets increase, that decreases expense. But payment of benefit affect the liability and the asset at the same time by the same amount, right? When the payment of benefit is made, both liability and the asset decrease by the same amount. So there's no impact on pension expense. Again, the expense to be recognized is not the same as the cash contribution. Okay, now we have talked about chapter 18, so we know expense goes to the income statement and the contribution goes to the tax return, right? So, and this will create a deferred tax thing, yeah. So pension expense is an operating expense. Are you surprised? No, because it's similar to wages, salaries, compensation expense, right? And so the cash contribution is operating cash flow, right? Now I covered everything. So the expense includes, the expense part is different under IFRS and under ASPE. Under IFRS, the pension expense are affected by this. Current service cost, that's straightforward. Yes, current service cost is just like salaries, wages earned, right? So that's there. And we call this net interest on net defined benefit liability assets. Okay. So to spell it out, you have the plan assets which earns a return, and you have a benefit obligation which accrues interest. Okay, so when the interest increase, your liability increase, that increase your expense. When the plan earns return, it increases your assets, decreases your expense, right? So that makes sense. So there are two things: interest on DBO and return on plan assets. So interest on DBO will increase your expense, and returns on plan asset will decrease your expense, right? So the net assets will be the net difference of these two. Except there's one detail we must pay attention. This is expected return, not actual return. Okay, this is expected return, not actual return. So how is this expected return determined? So right now, expected return basically is average long-term return, right? That's the same thing. So right now, remember this, the interest rate you use to calculate the interest must be the same as the expected return you use to determine, you use on plan asset. It's only one rate now. There used to be two rates, but now this two has to be the same. Okay, so therefore the calculation becomes, you apply the interest rate on the net defined benefit liability or assets, right? So if the PA and the DBO are the same, their net interest is 0. Okay, now what about well, this is the expected return. There is an actual return. The cash, the bond, the shares, the real estate, they earn the actual return, right? So why we use expected return, not actual return? And what do we do about the difference between the actual and the expected return? The answer to the first question is the market is volatile. The actual return is volatile, fluctuates, right? So if you put actual return in, your pension expense will be volatile. On a very good year, you will have a huge return, so you may have negative pension expense. On a bad year, you could have a huge pension expense. So your earning will be volatile. So under IFRS, it does not want the volatile earnings. It does not kind of accurately capture the performance. It could distort that. So that's the answer to the question. And secondly, what do you do with the difference between actual and expected return? You put it as a remeasurement gain and loss in other comprehensive income. So that's their mechanism to mitigate volatility. And there are four things in other comprehensive income, remember? So we cover, this is the second one we cover in this course. The first one is the gain losses with the cash flow hedge. Remember, there's a cash flow hedge, we do that, right? So that's there. And this, the unrealized or remeasurement gain losses from pension, that's two. And there's one from available for sales of the debt, investment in debt securities, right? So that's the only one that's a kind of fair value throughout the comprehensive income. That's an investment in debt securities classified as available for sale. And then one last one is related to foreign currency translation gain losses, right? I don't know that one probably is an advanced accounting topic. When you have subsidiaries that operate in foreign currencies, in consolidation, you have to translate all to your home currency. So any translation, foreign currency translation gain losses, that's the last one. So that's where it goes. And so is this actual gain losses. That's again, you know, so the reason these are all unrealized and they fluctuate, you know, and these are long-term, they fluctuate, right? The change some year, good year, you may have unexpected return, positive return, and some year maybe bad year will have unexpected loss. So over time, they kind of cancel each other out to great extent, so that by putting it in other comprehensive income, you mitigate the volatility of your earnings. And same as actuarial gains or losses based on the actuarial assumptions. The revision can go both ways, and so they offset each other over time. If not completely, it will be quite a significant extent. So these are all called the remeasurement gain losses goes in there. And the last one is past service cost. This one will also cause volatility, right? For sure, because usually it's a past service cost can be quite a significant amount. However, that is not included in other comprehensive income. One, conceptually, it's something already happened. So like a transaction, it's actually already happened, then you should recognize it. Two, there is no offsetting factors, right? It's unlike unexpected gain loss on the plan assets. The market fluctuates. This one, there's no follow-up happenings that will offset it, right? Does it make sense? So you revise your plan benefit to include past service, and that's already happened. There's nothing that's going to happen in the future that would offset it. So that's why this one is recognized. So we do not mitigate volatility at all costs. We'll only mitigate it when it's reasonable. Okay, makes sense. Now, so this will be our last slide today. We had did a lot of talking, so this will be last slide. Under ASPES, this part has to be different for the simple reason there is no other comprehensive income. So all that goes into pension expense, current service cost, that net interest, it's called the, they call it finance cost, but unexpected return on plan assets is included in there as well. And the past service costs, actual gains and losses. There is no other comprehensive income, so the parts that included in other comprehensive income and IFR would have to go into ASPE. Okay, so we actually did not have any journal entry today. As I mentioned, starting out, just knowing how the plan works is really important. And then what next time we'll come back, we'll illustrate the accounting part through this comprehensive illustration. And then that'll be the, I have very good reason to believe we will finish this week. The assignment is already on the Brightspace, so we should be able to do that, but not until after we have the archive, okay? And I think this time I give us until Monday? Sunday? Yeah, so we have the weekend to work on it. Yeah, okay. That's good for today. See you guys on Thursday.
Thanks, Professor.
Hello? Yes, go ahead. Oh, okay.